Both stock buybacks and dividends are methods companies use to return value to shareholders, but they operate differently and impact investors in unique ways. Understanding their differences helps investors decide which is more beneficial based on their financial goals and investment strategy. What are stock buybacks? A stock buyback, also called a share repurchase, occurs when a company buys back its own shares from the open market. This reduces the number of outstanding shares, which can lead to a higher stock price and an increase in earnings per share, EPS. Why do companies buy back stock? Boost share price. Fewer shares available can increase demand, driving up the price. Improve earnings per share, EPS. With fewer shares outstanding, earnings per share increase, making financials look stronger. Use excess cash. A company with excess cash might repurchase shares instead of keeping idle cash. Tax efficiency. Investors may prefer buybacks because they don't trigger immediate taxes like dividends do. Buybacks do not provide immediate cash to shareholders, but they can increase the value of existing shares over time. What are dividends? Dividends are payments made by a company to its shareholders, usually in the form of cash or additional stock. They are typically paid quarterly and provide a steady income stream for investors. Why do companies pay dividends? Reward shareholders. Dividends provide direct returns, making stocks attractive to income-focused investors. Signal financial stability. Companies that pay dividends regularly are often seen as stable and financially healthy. Attract long-term investors. Many income-focused investors prefer stocks with reliable dividend payments. Dividends are subject to taxes when received, which can make them less tax-efficient compared to buybacks. Key differences between stock buybacks and dividends. 1. Impact on shareholders. Buybacks reduce the number of shares, potentially increasing the stock price over time. Dividends provide immediate cash payments to shareholders. 2. Tax considerations. Buybacks are more tax efficient since they don't result in immediate tax liabilities. Dividends are taxed as income when received. 3. Stability and predictability. Buybacks are discretionary and can be stopped or adjusted based on market conditions. Dividends are often expected regularly, and cutting them can signal financial trouble. 4. Investor preference. Growth investors prefer buybacks because they help increase the stock price. Income investors prefer dividends because they provide steady returns. Which one is better? The best choice depends on an investor's financial goals. Buybacks are better for investors who want capital appreciation and prefer tax efficiency. Dividends are better for investors who want passive income and consistent cash flow. Conclusion. Both stock buybacks and dividends have their advantages. Buybacks help boost stock value over time, making them attractive for long-term growth investors. Dividends provide immediate income, making them ideal for income-focused investors. Companies often use a combination of both to balance growth and shareholder returns.